Josh listens to Wealth Talks on his way to work, and he asked us to do a rebuttal to a recent episode of the Dave Ramsey podcast where they're talking about the infinite banking concept. We happen to know a lot about the infinite banking concept, so if anybody could add perspective to Dave Ramsey's video, it would be us.
As a listener to the Wealth Talks podcast, you too can request episodes that answer your questions or just talk about more of something you want to know about. Just send us an email, producer@wealthtalks.com.
The video Josh sent us is called Heated Debate Between an Infinite Banker and Dave Ramsey. If you need more context to anything we talk about on this podcast episode, you can refer to that video. The link is in the description.
The caller is Jim from Nashville, and he has purchased a whole life policy on his son for $5,373 a year, and the policy will be paid up in 13 years.
What I found fascinating in listening to this episode of the Dave Ramsey Show was that although the title of the show was a heated discussion between an infinite banker and Dave Ramsey, they never really discussed the infinite banking concept.
No, every time Jen went to bring up the infinite banking aspect of the concept, Dave Ramsey would bring it back to life insurance and just focus on the life insurance aspect. The infinite banking concept is about using the cash value that you're building in life insurance so that you don't destroy the compounding when you use your money. The life insurance allows you to do that, but the infinite banking concept focuses more on the use of your money.
And I think that a big misconception for a lot of people that talk about the infinite banking concept is they want to consider it an investment. And they focus on the life insurance policy as that investment product. And that's not accurate.
Life insurance is an asset purchase. It can be used as a financial tool, the cash values of it, but it's not an investment. And Dave gets started right away and he says, your cash value dies with you.
This really puzzles me why he would come across like that, because Dave is really a big advocate of paying off your house early. He likes you to have equity in your house. And yet cash value is the equity of whole life insurance, and it's guaranteed where the equity in your home is not. We go back in time, 2008, not that long ago, there were people that had more equity in their house than what their house was worth. That means they couldn't get their equity out of it. Within life insurance, you're guaranteed to always be able to have access to that equity while you're living.
Cash value in life insurance is like your equity in the death benefit. So when your death benefit starts out, let's say at $500,000, your cash value is going to be much smaller than that. It's going to represent a portion of your equity, the part of your death benefit that you own. As you get older in a whole life insurance policy, by age 100 or 121, the cash value has to equal the death benefit. That's the way the product is designed. So as you get older, the cash value will grow to meet that death benefit.
And so to say that the cash value dies when you die is inaccurate, because if I leverage my cash value while I'm living and I purchase an asset, that asset doesn't disappear when I die. And that's what Dave did not talk about on the show.
But he understands that when it comes to home equity, because when you go to sell your house, you don't expect to get a check for the sale of the home and for your equity.
No,
Your equity is represented in the sale of the home. And it's the same thing with the cash value in a life insurance policy. The cash value is represented in the death benefit.
The caller jumped to dividends, and Dave quickly said, dividends are not cash value. And he's right.
Yeah, because the caller is saying, the dividends in my policy go to buy more paid up insurance. And Dave is saying, paid up insurance is not cash value. You're buying more insurance.
Paid up insurance is the true equity that you have in your death benefits. It's the part of the death benefit that's completely paid for. And you can have dividends by that. You can purchase a rider that buys that, or you can just buy a policy right at the very get-go and just pay one giant premium. And it's all paid up insurance. It's completely paid for with that one premium. Dividends are important though. And just because dividends are higher doesn't necessarily mean the policy is better than not, because dividends are one of those things that isn't regulated. In a recent example, a very small dividend multiplied the cash value in the policy by 19 times, whereas a very large dividend only multiplied the policy's cash value by about 4 times.
So you're talking about the amount of dividend paid to the amount the cash value increased because of that dividend on the non-guaranteed side.
That's right.
Okay.
And the reason that can happen is that dividends are not regulated on how they're reported or what they have to purchase.
So different insurance companies will calculate their dividends differently. So you can compare one insurance company's dividend history to its own history, but you can't compare one insurance company's dividend to another insurance company's dividend because they may calculate those differently.
And Dave Ramsey's right on this too, because dividends don't have to purchase paid up insurance. They can buy term insurance, which later on in the show he advocates that they should, or they can be taken as just a dividend check. And that could lead to a tax liability over time.
With the infinite banking concept, though, the preferred way to have the dividend is to have it purchase paid up insurance, because when you have it purchase paid up insurance, that also has to produce greater cash value. So dividends aren't cash value, but dividends purchase paid up insurance, which increases cash value.
And it can increase cash value substantially, like Jim is understanding here, because when you buy paid up insurance, most of the paid up insurance you're buying, that little chunk of insurance, is cash value. It translates directly to cash value.
It's important to have access to money while you're living. Jeff Bezos started Amazon.com on the free cash flow model, a metric, versus an investment type metric, a rate of return metric, because he realized that it's important to have money left over after you've paid all your liabilities, bills, and expenses. And people mocked him until 2004 when he took profits. And ever since then, that has become a metric for a lot of business people, because you can't fool around with the numbers. There's no hiding. There's no make-believe future returns. It's just, this is the money I have. This is the money I can go out and, like Jeff Bezos did, spend $13 billion and buy Whole Foods because he had the free cash flow to do that.
So this is the point in the show where Jim tries to go into the infinite banking concept. He says, but without the life insurance, I wouldn't be able to use the cash value. And Dave says that's a completely different issue. But it's not.
That's the infinite banking concept, is being able to leverage the cash value you have right now and have it continue to grow while you go out and buy other assets or make other investments.
At the root of the issue here, it's a philosophical difference. Some people want to be able to have the use of their money during their lifetime. Other people have a mindset of just saving for retirement. And that's the perspective that Dave is coming at this from. He is looking at it as an investment, put it away, save for the future. What do you have when all's said and done?
In fact,
Jim is looking at it, what do you get to use along the way? That's a big difference.
Yeah. What kind of free cash flow I'm going to have while I'm living, rather than when I get to an age where I can't produce anymore and I have to live off what I've collected. So right at this point in the video, Dave switches from the infinite banking concept to an investment mindset. And he says, if you would have put that money you're paying in premiums into a mutual fund, by the time this guy's 88, your son's 88, he'd have $25 million.
So we reverse engineered the scenario Dave is talking about here. He says if you could earn 11% in this mutual fund, then you'd have $25 million. Well, if you're earning 11%, you're going to have a whole lot more than $25 million. So there's some management fees and taxes involved. So we reverse engineered this. We found that there, with a 1% management fee and a 25% tax rate, then that 11% return gets you to $25 million at age 88. That's what Dave is talking about. But the problem is, where can you find a mutual fund that earns 11% consistently? I'd like to know about this investment that Dave is talking about. I'm also an investment advisor. People and companies send me their best investment options all the time because they want me to promote those to my clients. I have not seen a mutual fund that generates 11% consistently. But what I did find is when I looked at official financial planning software and looked at an 80-20 portfolio, that's a portfolio that's geared for growth, invested 80% in stocks and 20% in bonds and cash. So that's where the 80-20 comes from. Looking at the historical performance of the different sectors of the market for a diversified portfolio invested according to that model, the financial planning software is only projecting 7.38% return on that. They're looking back 15 to 54 years, depending on the sector of the market they're looking at. They're looking back 15 years for the bonds, they're looking back about 25 years for the stocks, and they're looking about 54 years back for the international component.
So that's quite a bit of difference from the 11% that Dave Ramsey's talking about.
It is quite a bit different. So if we put 7.38% return instead of an 11% return, that makes a huge difference. Instead of over $25 million, we have just barely over $3 million
Oh, wow.
at age 88. That is a massive difference. And if we're trying to compare this to the life insurance that Jim is buying on his son, we also have to take into account the term insurance that Jim's son would have to buy if he was investing in mutual funds instead of buying whole life insurance that includes a death benefit. So if we put the term insurance premiums in here, and he can't get term insurance until he's at 18 years old, so we have to wait that long. But if we take those numbers, start at age 18 here, and he's going to have to do this with a few different term policies over his lifetime. So this assumes that he's still insurable at the time that he is buying all these term policies. But if we put the term insurance premiums in there and take this out of the investment along the way, now at age 88, he only ends up with $2.2 million.
Which
Now,
ironically is really, really close to what this father will have for his son when his son is 88 years old.
Jim told us that he was going to have about $2 million in this policy for his son when his son is 80 years old. Dave Ramsey made the switch from 80 years old to 88 with the mutual fund example he shared. So if we look at the mutual fund at age 80, there's only 1.6, almost $1.7 million here in the mutual fund method if we use these realistic values.
So now what this father's done for his son is better than what Dave Ramsey's projecting.
Potentially. We don't know what the market's going to do.
It comes across as if Dave is using the present value calculation language as a way to discount Jim and his financial understanding. The funny thing is that Dave Ramsey is using the wrong terminology. He's using present value when he should be using future value.
The time value of money calculation includes 5 components: time, interest, present value, payment, and future value. You put in 4 of the components to solve for the 5th, and so you cannot solve for present value and future value at the same time.
We are not criticizing Dave for using the wrong term. It's easy to mean one thing and say another. But the fact that he's using the financial terminology he does know to browbeat someone, but doesn't actually have his financial terminology right, is slightly humorous. But that also means he's using the present value language to gaslight Jim. And that's not fair.
There's one other aspect that we need to look at in this scenario, and that is the fact that Jim or his son can borrow from this whole life insurance policy throughout their life and access money. Dave Ramsey could potentially do the same with his mutual fund example, because you can keep the mutual funds growing and you can take a margin loan.
In fact, as he interjects that, well, I can borrow from mutual funds, you can borrow from mutual funds, and that's true. But what is a mutual fund loan interest rate going for currently right now?
At Fidelity, it's 12.325% right now.
So at this point, I would just love to see Dave Ramsey talk about how he can borrow from his mutual funds at 12% or whatever. And I'd love to have Nelson Nash, who founded the infinite banking concept, in the same room together talking about this, because Nelson Nash owed $500,000 to banks for raw land, and he was paying 23%. And suddenly he realized, I could borrow from my life insurance policy and pay less than 23%. And, Dave is saying he can borrow from his mutual funds. It's over 12%. Policy loans right now are at 4 to 6%. And I can just hear Nelson Nash say, I rest my case. We're going to have a break, but we have more to come after the break.
While we're on break, I wanted to ask you to review the Wealth Talk show on Apple Podcasts. Over the years, we've received several reviews. Most of them were positive, but there are a couple negative ones. And Apple, for some reason, is choosing to feature those reviews, so it looks like our show has a 2-star rating. We're hoping by getting some more recent reviews, Apple will feature those and reflect a more accurate rating for the show overall. So please go and review the Wealth Talk show on Apple Podcasts. We appreciate it very much. Thank you.
Jim again tries to bring up the infinite banking concept and how you can borrow money against the cash values of your life insurance while you're alive. And Dave says, borrowing money to get rich says no rich person ever.
Oh my. Maybe you've heard of Bruce Howell. If you refer to episode 446 of the Wealth Talks podcast, we talk about the stops that we made at tire stores from our trip to Nevada to Indiana. Discount tire stores were started by Bruce Howell after he came back from the Korean War. And at first he sold cars and then he sold life insurance. And he was trying to sell life insurance to a buddy of his in high school that owned a tire store. And he goes, this is something I could sell. So he went back to his boss at the automobile dealership and he borrowed money to go into partnerships with his high school buddy in the tire business. Today, there's over 1,000 stores of discount tire across the United States. Bruce Howell borrowed money to become rich.
Robert Kiyosaki writes about his poor dad and his rich dad. His rich dad used other people's money. He borrowed money to get rich.
Howard Schultz borrowed money to start Starbucks. Howard Schultz borrowed money to get rich.
Donald Trump borrowed money to buy the Commodore Hotel in Manhattan. Donald Trump borrowed money to get richer.
Ray Kroc borrowed money against his life insurance policy to buy out the McDonald brothers. Ray Kroc borrowed money to get rich.
Walt Disney borrowed money against his life insurance to do the demographics for Disneyland. Walt Disney borrowed money to get rich.
So I don't know why Dave says no rich person ever, because there are numerous examples, we've just said a handful here, of people who borrowed money to get rich.
Next, Jim says that banks use this tool. Dave says they do not. You've been watching too much TikTok. Banks do not own whole life insurance.
At first I thought, why is Dave saying something that is so easily disproved? Because banks definitely own life insurance. Let me give you an example. If you live on the West Coast, you can go to Carl's Jr. But if you're looking for a Carl's Jr. east of the Rockies, it's Hardee's. Same restaurant, different name. If you live on the West Coast and you buy ice cream at the grocery store, you're going to buy Dreyer's ice cream. You're looking for that product east of the Rockies, it's going to say Eddie's on it. So what Dave is doing here is he's saying, banks don't own whole life insurance. He's right. They own bank-owned life insurance. And it's even got its own acronym, BOLI, B-O-L-I.
As of last year, over 3,000 banks owned life insurance. They just call it bank-owned life insurance.
So Dave, we're going to have to hand it to you on this one. Technically, you may be right that banks don't own whole life insurance, but it sure is tricky how you say that.
Banks may not own whole life insurance with their reserves, but they can own whole life insurance in things like their employee benefit plans. I don't think Dave or Jim were thinking about this specifically, but it is the case. So for Dave to go on to say that federal regulations don't allow banks to own whole life insurance, that's nonsense. When Josh asked us to review this Dave Ramsey episode, I don't know if he wanted us to comment on Dave's attitude, but it was rude, arrogant, caustic, condescending. Why does he treat people like that?
Psychologically speaking, Dave is using what is called superior posturing. And people who use superior posturing use it to intimidate people into submission or silence. Superior posturing is not used to build people up. However, it is used a lot in entertainment.
If Dave is a financial entertainer, it would be good to examine everything he says thoroughly before you take any of his advice or opinions literally. Dave says things that are right, he says things that are wrong, and he says them both emphatically and boldly.
You heard it today. Some of the things Dave said are right, some are wrong. So our advice is to carefully check things out and make sure they are true before committing to them financially or philosophically.
I don't know if it's possible, but I'd like to have Jim from Nashville on the Wealth Talks podcast. If you know Jim from Nashville that was on this episode of Dave's Ramsey Show, email producer@wealthtalks.com and let us know. It sounds like Jim has really put some serious thought into what he's trying to do for his son, and we'd like to hear more about it.
Internet, please do what you do best. Share this episode, post it on social media, and maybe we can talk to Jim soon, right here on Wealth Talks.